Fed hiked interest rates by a quarter point, bringing the target range to 5.5%. So where do we go from here? Hi, I'm Jake Schurmeier, multi-asset portfolio manager, with today's episode of the Harbor Lookout. So as you know, and as markets widely expected, the Fed hiked interest rates by 25 basis points at their July meeting. During the press conference, Powell really struck an optimistic tone about the U.S. economy. The consumer remains resilient, inflation is declining, we've seen steady progress there, and looking ahead, the Fed staff no longer has a recession in their forecast. And Powell, to himself, clearly revised up his personal odds of a soft landing. But looking ahead, Powell really wasn't giving any hints about September, because frankly, the committee just doesn't know. But to our ear, we think his preference is and continues to be that this is the end of the hiking cycle. However, there is a vocal portion of the committee who continues to believe that additional firming is necessary. And so again, as a whole, we think the committee truly remains data dependent, and they're not lying to us when they tell us they just don't know. It's impossible at this point to really place firm odds on what they're likely to do in September, whether that's an additional hike or a pause. And depending on that, what they may do in November and December. And so looking forward, we're really focused on three things. Is the committee's view of the policy transmission mechanism changing at all? We've seen now 525 basis points of interest rate increases, and yet consumption remains quite resilient. We've seen the housing market start to bottom. Fixed investment is really growing, partially because of the Inflation Reduction Act. And so are we learning something about this cycle specifically? Is it something about the amount of savings and household wealth that was generated following the pandemic? Or are we learning something more fundamental, that the US economy is less sensitive to interest rates today? And so related to this, the other thing we just don't know is, are we still waiting for the lagged effects of policy to transmit through the economy? It's been nearly 16 months since the Fed's first rate increase. And since then, we've really seen a limited impact. Is that because the lags are longer than that? Are these long and variable lags still to come, in Milton Friedman's words? Or are they shortened? There's a lot of debate about whether these lags are much shorter today than previously, because the Fed's more transparent about their intentions, so markets are able to price in tighter policy sooner. So, the question really becomes, are we still waiting for the other shoe to drop, or have both shoes dropped and we're through the other side? The economy's turning around, inflation's coming down, and we're really on the path to a soft landing. And finally, depending on the answer to those two questions, if push comes to shove, how willing is the Fed to go the last mile of inflation from 3% to 2% if it means a material increase in unemployment? That sacrifice ratio, so to speak, trading off employment for lower inflation, it really hasn't been a tangible question for the Fed. It's all rhetorical. It's in their forecasts. So when it actually comes to pass, should it have to, what is the Fed likely to do? And so those are the three things we're really focused on. And so without confidence in our answers to those questions, we're all left data dependent, just like the committee. So thank you for your time, and stay tuned for our next episode of the Harbor Lookout.